It is Friday. It is the midday, which means that we are doing Risk and Rewards. John Authers, Lisa Abramowicz. And really, to me, the one thing that stood out, John, is have we really put stagflation behind us? Forget the controversy over the word itself, but are we rebuying the reflation dip because everyone seems to be happy again?
Yes, for reasons that I don't understand. And that's not just because I'm habitually unhappy, but yeah,
the crowd.
Yeah, I mean, this is the thing that freaks me, or that is the weirdest disjunction. And there's a lot to choose from. Maybe we could just have a whole argument about what the weirdest thing going on at the moment is. 8 years ago, we have tapering of QE coming up, and as a result, real yields suddenly shoot from -1% in round numbers to +1% in a matter of weeks. This time around, we really more or less know that tapering is starting in a matter of weeks, and real yields have subsided yet again below -1%, kind of level that, not all that long ago we'd have just said that couldn't happen. And stocks are going to the roof, obviously fueled by such cheap money.
Okay, let's take a step back for a second and figure out where we are in the inflation, reflation, stagflation, whoflation kind of debate that we've been having for the past year or so. The idea this week was, yes, inflation is running hot. Yes, people are paying more for the prices at the gas pump or at the grocery store, or buying a home or whatever it is. Yet their wages are also increasing, and you see bonanza earnings for the big Wall Street banks. And you see, frankly, a lot of businesses able to pass along a lot of the costs to consumers who still are willing to spend. This is all not stagflation. This is potentially at a slower pace reflation, and that's what the stock market's reflecting. However, there are other signs of caution to your point about weirdness. Do you think that we can kind of all jump on this train of, yes, reflation, but just a slower pace than perhaps people previously thought?
That's not a bad way of looking at it. I mean, it sums up where we've got to very nicely. I think the other thing you need to throw in is the politics of the situation, because fiscal policy matters, and part of the reason for great excitement at the beginning of the year was the blue wave. I'm not saying that necessarily everybody who was buying stocks was a big fan of Joe Biden, but they were a big fan of the government spending a lot of money at this juncture. And you've seen the fiscal policy move very dramatically in one direction for much of the year, and now that's easing off, which means that you get less real bullishness about a big, exciting reflation, but it still provides some kind of a bulwark against any notion that we have to worry about stagflation. And the thing that doesn't make sense to me about what's happened this week is that in many ways the debate about whether the inflation we've had at the moment is truly transitory is over now. It's not transitory in the sense of it was just a statistical quirk caused by low base effects from comparing to really low prices during the worst of the pandemic, and you don't need to do anything about it. It's not as simple as that. I think we can dismiss that because inflation is still at high levels by any number of different measures, and Lord knows I've explored enough different measures of inflation. And so we've decided, we've got James Gorman of Morgan Stanley, we've got Raphael Bostic, who might just be the next chairman of the Fed, both very, very firmly saying, no, this isn't transitory. This is the week we've absolutely decided that whatever this inflation is, it's not something that's just going to go away quickly without our doing anything about it.
Yeah.
And people have gone out and bought stocks with great excitement, and risk is back on. That is an odd combination that I cannot explain for you.
And by the way, your reference there is that you are a little sick of talking about inflation, and yet it is the only topic, frankly, this year and probably beyond, because it's what's driving the narrative on Wall Street and on Main Street. To this point of what the conflicting data is this week, the weirdest things that we saw this week, let's go straight there because it goes right to what you were saying. Yeah. For me, the weirdest thing is today. We got retail sales that beat expectations. They came in at 0.7% month over month of an increase. The expectations were 0.2% decrease. At the same time, consumer sentiment, as measured by the University of Michigan Sentiment Survey, fell to the second lowest since 2011. Inflation expectations for the near term rose to the highest levels going back to 2008. All of these data points show that people are getting concerned. They are not going to spend as much, saying they're not going to spend as much in cars. And then you see the spending data and they're going out and they're spending like bonkers. It's not coming together with a cohesive narrative for me.
Again, it's our job as journalists to tie things together in cohesive narratives.
Help me.
And I can't do that either. I guess that I think the narrative, if there is one, I would certainly agree with you that today's data really make it very hard to go along with the notion of stagflation. It's possible that there is too much of an inflation scare going on in consumers as a whole, which then raises this. There's been an arcane debate that's actually been conducted in public within the Fed about whether inflation expectations matter. The rather intriguing paper by a Fed economist saying they didn't. I am still a prisoner of the economics I was taught at college and find it difficult to conceive of how they don't. That the logic of what I understand is that what we've seen from retail sales is people really do think prices are going up, so they're making sure they buy now, and they have money in their pockets post-pandemic, and so they're taking the opportunity to buy now before prices go up. In the process of doing that, they make prices more likely to go up. It's a form of it's certainly not stagflation. It's the kind of economic move that people have been desperately hoping would happen for a decade, and now it's here.
Well, but I want to go to an article that you wrote that was an excellent article about that goes to the other side of this equation. It's one thing to have prices going up. That could be stag very quickly if people aren't getting incomes that are rising at a similar pace. And right now, they still are not rising at the same pace. We are getting negative real wage growth. If you take a look at the wage growth versus the inflation reads. However, you pointed out something really interesting about job openings, people who quit their jobs and then get jobs again. Can you give us a sense of how this factors into what we are seeing in terms of inflation that's not stag?
Exactly. What we are seeing in the job market is that basically, trying not to sound too political as I say, the boot is on the worker's foot in a way that it hasn't been for 2 decades. That workers are behaving as though they have more negotiating power, and judging by the money they're getting, they are succeeding in doing so. So numbers that we've had this week, the number of small companies complaining that they have jobs open that they just can't fill is above 50%. That's the first time that's ever been true, and they've been running the survey since 1974. So extreme difficulty for companies getting people to sign on the dotted line. Then the average pay rise for people who switched job last month, according to the Atlanta Fed, 5.4%. Still, actually, not a great rise by comparison to headline inflation, but that's the best increase job switchers have got in 20 years. So there's obvious, real power for people on that side of the labor force that's not been around for a long time now. In terms of the ills that affect society, this is what everybody's been complaining about for a very long time with very good reason. We've seen, growing inequality, the hollowing out of the working class. It's not for us to talk about sociology, but we all know that that's a very serious problem. We see the beginnings of a reversal of that trend, which ought to be positive. It will mean, by the looks of it, more inflation, that we're just going to move back to an economy that follows the rules, if not of the 70s, then at least of the 80s and the 90s for a while. And that will be an interesting adjustment.
The resurrection of the Taylor rule.
Yes,
but
yes, exactly.
Right? It's sort of, have we seen it come back to life?
Yes.
Though as you speak, something that sticks in my head, Danny Blanchflower of Dartmouth, he came out with a really controversial study where he basically was saying he sees recession in the next 18 months, which is something nobody is saying. Everybody else is saying, no way do we see recession. And he's pointing to the consumer sentiment indicator. And he said, this has been predictive 6 of the 6 past recessions. About 18 months out, you start to see consistent declines, deterioration in consumer sentiment. this flies in the face of what you're talking about. And I asked him about that earlier this morning. I said, listen, people say, but look at how tight the labor market is. And you can tell it's tight because of how much you're seeing those wages increase. And he said, it's not as tight as it seems. And his argument was, this is the evidence of people being scared to go back to work because of COVID, because of childcare issues, still being an issue that sort of is an obstacle. As soon as that ends, this tightness disappears. And that he's saying, so in other words, the power that labor has now isn't sustainable without something more structurally that changes. It's an interesting debate. It really goes to the heart of uncertainty. We don't know whether this is a tight labor market, a loose labor market. We don't know whether inflation is going to get ahead of the Fed or behind the Fed. I mean, honestly, these are some of the fundamental disagreements right now.
That's fascinating. So the notion is that this is not so much a transitory blip in inflation as a transitory blip in labor power.
Correct.
I guess that's conceivable. I think the extent of the difficulty that companies are reporting and the way in which, and the other thing, if you burrow into the Atlanta Fed data, people with a high school diploma or worse are getting higher pay rises than people with bachelor's degrees or better. First time that's been true since they started running the survey, and so on. There are some pretty intriguing, profound things happening. It's possible, given how much of a departure from the previous trends it was, that this is all transitory. That being said, the last 20, 30 years were fairly different from the 20, 30 years that came before that.
And to your point, just to sort of edify that, if people on the lowest end of the wage spectrum are actually getting the biggest increases, that might have the most direct boost to economic growth, simply because those are the individuals that will spend more of their marginal income, right? So that actually bears fruit in terms of a disproportionate boost to growth going forward and potentially creating this spiral. So, there are all sorts of different arguments on that side. Going forward, though, I'm looking at this, and I think that the biggest change also in this week, we should touch on this, is bringing forward expectations for rate hikes. Basically, people are saying the Fed is going to take action. People are worried about inflation. They are being given a go. Markets rallied, even though they came out and said they were going to taper. And then the minutes come out, and it says that they want to end their asset purchases by the middle of next year, indicating that they could hike rates next year once, if not twice, as per market predictions. This, to me, a huge sea change, the market shrugging it off, seeming to indicate it can handle it.
Yes. The hope was we disagree about things. That's my take as well. I think we've plainly moved to the point where the Fed is wanting to give itself as much space to move quickly as it can, because there are definitely cold feet in the Fed now. There was one line, which I don't have in front of me now, but where they did say in as many words that some of these pressures were greater than they had expected, which is about as close to admitting you were wrong or changing your mind in public as a central bank can ever come. I mean, you should admit you're wrong if you're wrong. I'm not criticizing them for it. I'm just saying that this was a very clear sign that they are getting, that they're moving towards hawkishness very quickly. The way that was treated, you got the flattening yield curve. You got inflation break-evens are still not back to the highs for the year. Yes, obviously, the two-year bonds have, that would have been ridiculous if they hadn't risen significantly. But there's been no particular move further out. I think that tends to suggest the way you were putting it. I mean, I'm trying. This is like seeing what the market has done and then trying to come up with some rationalization or some model for what might have justified this. This isn't the way this should work, but it does involve what you were saying. It's not the blue wave; it's a sort of blue trickle. It's rates are going to go up earlier than we thought. The Fed may actually already be a little bit behind the curve, which means they have to raise rates a bit more than they were wanting to, with the result that the 10-year actually comes back in a bit, because we now think the Fed's got this slightly wrong and we're going to have tighter, slower growth at the end of it than we were hoping. That's game theory from here, or ex post rationalization as best I can do it from here. Does that seem to make sense to?
Yeah, I mean, it's basically you hike sooner, and then all of a sudden you slow growth more on the back end, which seems to be what's being priced in. We're out of time. We didn't do risks and rewards because, frankly, the whole story and the only story in markets this week, to me anyway, was inflation, the response to it in markets as well as by the Fed. But I think you summed it up pretty much the entire time, which is what you said, which is this isn't the way it's supposed to work. None of the data is really coming together in a cohesive narrative as we've been talking. So it'll be interesting to keep tracking it as we have our Friday chats going forward. Have a wonderful weekend, and I'll talk